We get stagflation or deflation. Can you explain what those two are?
Stagflation is like the kiss of death. Stagflation is essentially what happens when you have high inflation. So this is inflation reigniting, but the problem is the economy slows down at the same time. And so it's this double whammy effect that just starts really just beating the crap out of the economy. The last time we had stagflation was actually during the late 70s. Basically, it happened in the 1970s. And then right after that, we got hit with another bout of inflation because they thought they had it stamped out. They didn't raise rates high enough. Sounds kind of familiar. They didn't raise rates high enough. Inflation just came roaring back. Then Paul Volcker had to step in and Paul Volcker us and take rates, where all of a sudden interest rates for real estate were 18%. Deflation, on the other hand, is when the GDP for the United States starts going backwards. When we're a consumer-based economy and prices start dropping. So what's interesting is everyone goes, I want prices to drop. You actually don't. If prices start massively dropping, because we're a consumer-based economy, it is a death spiral and starts sucking everything in like a black hole. So the last time we had major great deflation was during the Great Depression, and our economy sank by 30%. GDP got 30% smaller. Comparatively, deflation was also experienced in 2009, and economists consider that mild deflation. See how the consumer wants prices to go down, but if deflation actually happens, you end up with the Great Financial Crisis or the Great Depression. In those cases, you would expect with stagflation or deflation, unemployment to be 5 to 10%. Now, unemployment could get unbelievably high if all of a sudden we went into the Great Depression. I don't think they'll let us get there because the Fed can't stop this one. This one is the proverbial snowball. And because true inflation is already showing us at 1.2% as the true inflation read versus what the government's reporting to us, this one feels like almost even less of a possibility. Home sales would stay about the same because we're already at the low. You stay about 4 million units. Home prices would stay slightly down. All you'd have to do is go look at what happened in the 70s and 80s, and home prices through most of those recessions right there went like this, boop, a little dip down.
Because people always need homes.
Because people always need homes, and right now what's different is, once again, depending on how we measure it, you are 1.8 million to 4.5 million units behind in the US from the Great Financial Crisis. We just have not built enough to keep up. So that's going to artificially prop up real estate during this. The problem is Fed can't lower interest rates. And because I don't believe this is as much of a possibility, I think debt would stay in a similar range of 6 to 8%. I don't believe we can Paul Volcker ourselves because the national debt is so much higher today that would bankrupt the country. If you disagree or agree with any of these things, come on guys, drop them in the comments. Tell me where I'm wrong. Tell me where I'm right. Tell me where we're missing something here. Because what we did to prepare for this, we went back through historic data. We looked at the possible scenarios that are coming based on the Federal Reserve, and then came out with outcomes based on history. You can reach us at resg.com. Thank you for watching. Hit the subscribe button. Let's connect.